Understanding home mortgage loans, turning homeownership into reality. Buying a home is one of the biggest financial decisions most people will ever make. It's a symbol of stability, independence, and accomplishment. But for the vast majority of people, paying cash for a home isn't realistic. That's where home mortgage loans come in. They make it possible to purchase property now and pay for it over time. A mortgage isn't just a loan. It's a long-term financial commitment that shapes your budget, your wealth, and even your lifestyle for decades. Understanding how mortgages work, the different types available, and how to manage them wisely is key to making the most of your investment in home ownership. What is a mortgage? At its simplest, a mortgage is a loan used to buy real estate. You borrow money from a lender, typically a bank or mortgage company, to purchase a home, and you agree to repay that amount, plus interest over a set period, often 15 to 30 years. The home itself serves as collateral, meaning if you don't make your payments, the lender can legally take possession of the property through a process called foreclosure. Because the loan is secured by the property, mortgage rates tend to be lower than unsecured loans like credit cards or personal loans. Mortgages are designed to make large purchases affordable. Instead of paying hundreds of thousands of dollars at once, you make predictable monthly payments over many years. That structure allows millions of people to build wealth through homeownership who otherwise couldn't afford to buy a home outright. The anatomy of a mortgage payment. Each monthly mortgage payment is typically made up of 4 parts, commonly known as PITI. Principal: the amount you borrowed that still needs to be repaid. Interest: the cost of borrowing that money, determined by your loan's interest rate. Taxes: property taxes charged by your local government, often collected monthly and paid through your lender into an escrow account. Insurance: homeowners insurance and sometimes private mortgage insurance, PMI, to protect the property and lender against loss. Early in your loan, most of your payment goes toward interest rather than principal. Over time, that ratio shifts, and more of each payment goes toward reducing the actual loan balance. This gradual shift is known as amortization. It's why homeowners build equity slowly at first and faster in later years. The different types of mortgages. Not all home loans are the same. The type of mortgage you choose affects your monthly payment, interest cost, and how much you can afford. 1. Fixed-rate mortgage. With a fixed-rate loan, your interest rate stays the same for the entire term of the mortgage, usually 15, 20, or 30 years. This stability means your monthly payment, excluding taxes and insurance, never changes, making it easier to budget. Fixed-rate loans are ideal for people planning to stay in their home for many years or who prefer predictable payments. 2. Adjustable rate mortgage. ARM. An ARM offers a lower initial interest rate for a set period, for example, 5, 7, or 10 years, and then adjusts periodically based on market conditions. When rates are low, this can save you money in the short term, but if rates rise later, your payments could increase. ARMs suit borrowers who expect to move or refinance before the rate adjusts. 3. FHA loans. Backed by the Federal Housing Administration, these loans are designed for first-time buyers or those with lower credit scores. FHA loans allow smaller down payments, as low as 3.5%, and more flexible qualification standards, though they require mortgage insurance premiums. 4. VA loans available to eligible veterans, active duty service members, and certain military spouses. VA loans are backed by the U.S. Department of Veterans Affairs. They often require no down payment and no private mortgage insurance, making them one of the most affordable financing options available. 5. USDA loans. For homes in rural or suburban areas, the U.S. Department of Agriculture offers loans with zero down payment for eligible buyers. They are meant to promote homeownership in less densely populated regions. 6. Jumbo loans. These loans exceed the conforming loan limits set by the Federal Housing Finance Agency, FHFA. Because they're larger, they often require higher credit scores, larger down payments, and stricter financial documentation. The benefits of having a mortgage. A mortgage is more than just a debt. It's also a financial tool with multiple benefits. 1. Home ownership and stability. Owning a home brings a sense of permanence and control. You're not at the mercy of rent increases or landlord decisions. You can make improvements, decorate, and truly make the space your own. 2. Building equity. Every mortgage payment you make increases your ownership stake in the home. Over time, this equity becomes a powerful asset, one that can be used to borrow against or generate profit when you sell. 3. Potential for appreciation. Historically, real estate tends to increase in value over the long term. That appreciation can dramatically grow your net worth, especially if your mortgage payments remain stable while property values rise. 4. Tax advantages. In many countries, mortgage interest and property taxes can be deducted from taxable income, reducing your overall tax burden. This makes owning a home financially advantageous compared to renting, though it's wise to consult a tax professional for specifics. 5. Leverage and wealth building. By putting down a small portion of a home's cost, say 10 to 20%, and borrowing the rest, you're using leverage, controlling a large asset with relatively little upfront cash. If your property appreciates, your returns are magnified. For example, a 10% increase in a $400,000 home equals $40,000 in equity growth, even if you only put $40,000 down. How to qualify for a mortgage. Getting approved for a mortgage involves demonstrating to a lender that you can handle the debt responsibly. Lenders consider several key factors known as the 4 C's. 1. Credit history. Your credit score shows how reliably you've handled debt in the past. A higher score often means lower interest rates and better terms. 2. Capacity. Lenders look at your income, job stability, and debt-to-income ratio, DTI, the percentage of your income that goes toward debt payments. 3. Capital. This includes your savings, investments, and other assets that could serve as backup if you lose income. 4. Collateral. The property itself serves as collateral for the loan. The lender will require an appraisal to confirm its market value. To improve your chances of approval, pay down existing debts, avoid major new credit applications, and save for a reasonable down payment before applying. 1. Pre-approval. Before you start shopping for a home, it's smart to get pre-approved. A lender reviews your finances and gives you an estimate of how much you can borrow. This helps narrow your home search and shows sellers that you're a serious buyer. 2. House hunting and offer. Once you find the right home, you make an offer. If accepted, you enter into a purchase agreement contingent on final loan approval. 3. Loan application and processing. The lender collects documents such as pay stubs, tax returns, and bank statements. They verify your financial information and order a home appraisal. 4. Underwriting. This is where the lender thoroughly evaluates your creditworthiness and the property's value to ensure it meets lending standards. 5. Closing. Once approved, you sign the final loan documents. You'll pay closing costs, which include fees for appraisal, title insurance, and lender services, and ownership officially transfers to you. 6. Repayment. After closing, you begin making monthly payments according to your loan terms. Over time, you build equity and eventually, full ownership. 1. Choose the right term. A 30-year loan offers smaller monthly payments but costs more in interest over time. A 15-year loan has higher payments but saves thousands in total interest. Consider what fits your budget and long-term goals. 2. Make extra payments. Even one additional payment per year toward your principal can shave years off your loan and save you significant interest. 3. Refinance strategically. If interest rates drop or your credit improves, refinancing your mortgage can lower your rate or shorten your term. However, always factor in closing costs to make sure refinancing truly saves money. 4. Protect your credit. Late payments can damage your credit score and result in penalties. Setting up automatic payments ensures you never miss a due date. 5. Review property taxes and insurance annually. These costs can change over time. Review your escrow account and shop for better insurance rates when possible. 6. Build an emergency fund. Life is unpredictable. Having savings set aside ensures you can continue making payments during financial setbacks. Common mistakes to avoid. 1. Buying more house than you can afford. It's easy to fall in love with a dream home, but stretching your budget too thin can lead to stress or even foreclosure. Stick to what you can comfortably afford. 2. Ignoring additional costs. 3. Focusing only on the interest rate. 4. Forgetting to revisit your loan. The broader benefits of homeownership. Beyond the numbers, owning a home offers emotional and social rewards. It provides a sense of belonging, privacy, and community. You can build roots, personalize your space, and feel pride in something that's truly yours. Homeownership has historically been one of the most consistent paths to intergenerational wealth, giving families a foundation to build upon for decades. It's also a form of forced savings. Every payment you make increases your equity, unlike rent, which vanishes each month without building any financial value. Over time, a well-managed mortgage can transform from a liability into one of your greatest assets. Final thoughts. A home mortgage loan is more than just a financial transaction. It's a bridge to opportunity, stability, and long-term security. Understanding how it works empowers you to make informed decisions that can shape your financial future for the better. Whether you're a first-time buyer or an experienced homeowner, success in real estate starts with knowledge. By learning how interest rates, loan types, and amortization affect your payments, you can turn your mortgage into a strategic tool for building wealth. The path to home ownership may seem daunting at first, but with careful planning, smart budgeting, and the right mortgage, it becomes not just achievable, but profoundly rewarding. In the end, a home is more than an investment. It's the foundation where life's best memories are made.